This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 3 videos on trading climactic reversals. A climactic reversal is simply a failed breakout. I want to begin by talking about major climactic reversals, and then I'll talk about how a microchannel can also be a climax, even in the absence of big trend bars. This is a 5-minute chart of the euro versus the dollar, and you can see a couple exceptional bars, a very big bear bar here, and a very big bull bar here. I'm going to be talking about climaxes, which can be the end of a trend, and sometimes the start of an opposite trend. Whenever you see an exceptionally big trend bar, especially if it's occurring late in a trend like this, after 20 or more bars, you have to be thinking that it might be the climactic end of the trend and possibly the beginning of an opposite trend. This was the end of the bear trend, and the bull trend really did not start until about 20 bars later. This is the end of the bull trend, and it became a weak bear trend into the end of the session. Whenever you see an exceptional bar like this, the biggest bull trend bar occurring 20 or more bars into the trend, this bar is occurring about 30 bars after the higher low major trend reversal and about 50 bars after the end of the bear trend. You have to be thinking that it's more likely a climactic end of the current leg up and less likely the start of an even stronger trend up. And here we have a bear bar following the bull bar. We're breaking above the top of the trading range, and this is terrible follow-through, especially after an exceptionally big bar, which might be a climactic end of the bull trend. Traders see this bear bar as bad follow-through after this strong bull breakout, and whenever you get a very big bull bar late in a trend like that, 60% chance it's going to be an exhaustive end of the trend, and only 40% chance it's going to be a measuring gap leading to an even stronger leg up. 60% chance the market's going to work down to the bottom of the bull trend bar. Here, we're trying to get a bull breakout above a bull channel. 75% chance that's going to fail. And we're also trying to get a bull breakout above the top of the trading range, with terrible follow-through probably going to fail as well. When the context is good like this, the biggest bull bar occurring 20 or more bars into the trend, there's a 60% chance that the market is going to have at least 10 bars and 2 legs sideways to down to test the bottom of the biclimax bar. That means the probability favors the bears, even though it's a strong breakout in a bull trend. Because of that, bulls will sell out of their longs, they'll take profits, and strong bears will begin to sell either on the close of that bull bar, betting that it's probably an exceptionally great price for the bulls to take profits, and other bears will sell on the reversal down. Terrible follow-through bar, a bear bar, after breaking to a new high. Bears will sell on a stop below that bear bar. Other bears will sell on the close of the bull bar and use a stop that might be a little bit more than a measured move up based upon the height of the biclimax. So from here to here, measured move up here. Traders will either sell the close of the bull bar, sell the close of the bear bar, or sell below the bear bar and get filled right here. It's a micro double top. We went up on this bull bar, down on that bear bar, and then up on this bull bar again. And if we go down, that becomes a micro double top with this high, and then down, and then this high, and then down. They'll sell below that bear bar. After the market's had 3 bars down, 3 bear bars, traders start to assume the odds are we're reversing and we'll get at least a second leg down, and therefore a high 1 buy is probably going to fail. Traders will sell with a limit order at the high of that 3rd consecutive bear bar, betting that we'll get a higher low and we'll test down to the bottom of the biclimax bar. That will get an exhaustion gap. The gap at this point is the low of this bar and the high of that bar. And then as each bar gets added, the gap gets smaller. At this point, the gap is the low of this bar and the high of that bar. The odds are the gap will close. The odds are we're going to get down to the bottom of the buy climax bar. A lower high, a second leg down, is likely, and therefore traders will sell as the lower high begins to reverse down, especially below a bear bar. Theoretically, after any strong breakout to a new high, the bulls are going to raise their stop to just below the bottom of the most recent breakout. However, when you have an exceptional bar like this, a very big bar, the biggest bull bar occurring late in a trend, you should be getting out up here, not down here. This is a magnet. The low of this bar is a magnet. There's a 60% chance that the market is going to reverse down to its low. And therefore, this is not where you're going to get out because there's a 60% chance your stop is going to get hit. Better to get out up here. Theoretically, some bulls will have their stops here, and they'll allow their stops to be hit. I think that's a bad decision. Whenever you have an exceptional bar like this late in a bull trend, that is a terrible place to put a stop. You either use a much wider stop, betting that it'll come down to this low and reverse up, resume back up, or you get out at the top of the buy climax or as soon as it starts to reverse down. Take a look at this bar. This is the biggest bull bar, and it's occurring more than 20 bars into a bull trend. It's a surprise. And whenever the market does something that is surprising, it usually requires some kind of a test to see if the bulls will repeat the buying that they did earlier. The market sometimes pulls back a little bit, and that is all you get for the test, and then you get a big move up. Or sometimes it pulls back all the way down to below the bottom of the bar. Will the bulls buy again? Is this really the start of a measured move up? Is it going to be a measuring gap? Maybe a measured move up based upon the height of this low to this breakout point, or this low to this breakout point, and then we get a big bull trend? Or is it an exhaustive end of the move? The biggest bull bar late in a bull trend, 60% chance it's an exhaustive end of the move. Sometimes you get a second buy climax, and then you get a reversal down to below the bottom of the buy climax bar. Here we have a 1 bar attempt at resumption up, and then we started the pullback. Other times it reverses down immediately. What the bears want to see is a bear bar closing near its low. They'll sell below that low. A lot of bears will sell that close, and if we get a small second leg up, they'll sell more higher. This is a major higher low. If the bulls buy somewhere above it, they will conclude that, yes, they are in control, and we're going to get some kind of a measured move up. If the market falls 3 or more pips below the low of this bar, then the bulls did not buy strongly again at this price. This is therefore more likely a climactic end of the trend, and then the market will either be in a trading range or possibly a bear trend. This low is therefore major. It's a major higher low, and the bulls should not allow the market to fall below it. Sometimes it'll fall a pip below, sometimes 2 pips below. If it falls more than that, then traders will conclude the bull trend has ended. Bulls see a strong breakout and they want a measured move up, at least based upon the size of the bar. They're looking for the market to get up here. Their risk is to below the bar. The bears see it as a climactic end of a bull trend, and they're looking for a measured move down. They want it to break below the low of the bar and fall for a measured move down based upon the height of the bar. At a minimum, the bears who are selling here want the market to get all the way down to the bottom of the bar. So that is their minimum reward. And the bulls, their stop is right below the bar. So that is about the risk for the bulls. So the risk for the bulls and the reward for the bears is the same. The bears might hold for a much bigger reward, but their initial reward is a test of the bottom of the buy climax. The bears do not want the breakout to go more than a measured move up. If it does, they'll conclude that this is a measuring gap, and we may go for a measured move based upon this low to this high, which would be very far up. If there is a second leg up, the bears expect it to be weaker because trends tend to weaken as they progress, and therefore the bears are willing to risk a measured move up based upon the height of that buy climax. The risk for the bears is up here, and the minimum reward for the bulls is the measured move up based upon the size of this body. Risk for the bears is equal to reward for the bulls. Risk for the bulls is equal to reward for the bears. What's different is probability. The biggest bull bar late in a bull trend is more likely an exhaustive end of the trend than the start of an even stronger leg up. Some bears will sell that close, betting on a move down here. Others will sell below that bar. But what's different? The difference is the probability favors the bears. 60% chance we're going down here before we get up here. If you have a 60% probability for a trade, it's reasonable to take a profit at 1 times your risk. For the bears, their risk is here. Here's 1 times their risk, and therefore they can take a profit down here at only 1 times their risk. Their actual risk is, it turns out, much smaller. If they sell this close or they sell that bear close or below the bear bar and get filled over here, their actual risk was very small, and this is 2 to 3 times their actual risk. That creates an adequate trader's equation. However, the target that I'm using is their initial risk, and exiting down here is 1 times their initial risk. Initial risk is always at least as big as actual risk. Here it's several times greater than actual risk. The trader's equation is based upon actual risk, not initial risk, and therefore bears exiting down here, they have a very good trader's equation taking that short. Profit target for the bears at or just below the bottom of the buy climax bar. It's reasonable for the bears to initially put a stop slightly above a measured move up and go for a target at that same distance at the bottom of the buy climax bar. Stop just above the measured move. Sometimes if you have a sell setup and you have good context, and the bears do have good context here, and you have a good sell signal bar, they have a good sell signal bar here. Once it falls below the low of that bar, they can put their stop to just above the high of that bar. For example, if they sell there, below the bear bar, they could use a tighter stop just above here. And their actual risk, in fact, had they sold below the low of this bear bar, they get filled here. Their actual risk was very small, maybe about 5 pips, and the reward is more than 20 pips. So excellent risk reward in addition to excellent probability. What are the chances that the market's going to go from a bull trend into a bear trend? Well, not very good when the bull channel is tight like this. This is still probably a minor reversal, and that means it's probably going to lead to a trading range, especially since it's coming late in the day. This is 10 o'clock Pacific time, and you can see the bars are starting to get small. Traders are stopping trading, not much movement left in the day. Given that we're running out of time, and given that the channel is tight and we're probably not going to get a bear trend, the bears will probably end up scalping out of their trade. Also, most climactic reversals lead to trading ranges and not opposite trends. And that's another reason to look to scalp out around the target, the bottom of the bull breakout. If it falls below that, you got to be thinking, okay, maybe we'll get a double bottom at the bottom of the buy climax and break above the neckline, which is here, and go up for a measured move. Instead, if it breaks below the bottom of this bar, it's breaking below a theoretical double bottom. The target would therefore be a measured move down. If the market breaks below here, and it did, if you want to hold for a swing, this is your next target, a measured move down based upon the height of the buy climax. Sometimes you'll hear traders talk about a V top, where the market goes straight up and straight down, or they'll call it an inverted V because it's an upside down V, or they'll call this a V bottom. But actual V tops and V bottoms are very rare. They're almost always something else, but you have to look for what the something else is. You can get a V top or a V bottom on some surprise news event, but that is rare. And therefore, if you're going to get a climactic reversal, there's usually some evidence that it will develop before it actually develops. For example, here we have a wedge, 1, 2, 3, a bull breakout above a bull channel. And we also have an expanding triangle, although the shape is not very good. First push up, higher high, and even higher high, and then we have a low in between. Every time you see a big bull trend bar or a big bear trend bar, it's testing something. And therefore, every big bull trend bar is a bi-vacuum test of some kind of resistance, even if you do not see the resistance. Likewise, every time you see a strong bear trend bar, it's always a test of some kind of support, even if you do not see the support. However, it's always good to be constantly looking for support and resistance so you can anticipate when a breakout might reverse. I think this is interesting. We have the biggest pair of bear bars occurring 20 or more bars into a bear trend. The initial breakout was big, but after the breakout spike channel, we're suddenly getting another breakout. What is more likely? Is this the beginning of an even stronger bear trend, or is it more likely that it is an exhaustive end of the bear trend? Whenever you get a big breakout late in a bear trend, it's more likely the exhaustive end of the trend, not the start of an even stronger leg down. It's a surprise. When you see a big breakout like this occurring late in the trend, that's something that is a low probability event. Whenever there's a surprise, the market usually tries to test back up to that price to see if the bears will again sell somewhere in this general area. And if so, then they have a reasonable chance at a measured move down, a gap and a measured move down. On the other hand, if the market starts to go up and the bears are not selling, then there's something wrong with the bear case. If the market goes more than 2 or 3 pips above the top of this bar, then this probably is an exhaustive end of the bear trend. The market then is no longer in a bear trend, it's either in a trading range or possibly a bull trend. This high then is a major lower high. If the market gets above it, it changes everyone's perception. If you're a bear and you're selling anywhere in here, even if you sold up here, you're going to put your stop just above the high of this major lower high once you see the close of this bar. Most bears are going to exit before that stop gets hit. For example, they might get out above a strong bull bar. Once they see this strong bear close, they know there's a 60% chance this is the end of the bear trend. So some bears will use this as an opportunity to exit. Bulls know it's probably an exhaustive end of the trend, and some bulls will buy that close, or, higher probability, buy above the high of this strong bull bar. If you're a bear, your minimum goal is a measured move down based upon the height of the sell climax. More likely, you'll expect a measured move down based upon a gap. The bears are trying to keep the gap open, so maybe from this low to this high or this high. So measured move down all the way down below the bottom of the screen. But their minimum goal is a measured move down based upon the height of the climax, and their risk is here. If you're a bull, you expect you might get a second leg down. Here we have a tiny second leg down, but you also expect that late in a trend, the trend should weaken. If there is a second leg down, it should not be as big as this. And therefore, the bulls who buy that close or above this bar will put a stop a little bit more than a measured move down. The risk for the bulls is the same as the minimum reward for the bears. On the other hand, the bulls are trying to get above the top of the sell climax, so their minimum reward is here, but they're hoping for much more. And if you're a bear, You put your stop just above this high because if your premise is correct and this is the start of an even stronger leg down, it should not get above the high of that bar. This is a major lower high. It changes everyone's opinion if the market gets above it. The risk for the bears is up here. The minimum reward for the bulls is up here. They're looking for much more, but that's their minimum. We have an attempt at a trading range. You can call it a double top bear flag neckline, and the market fell for a measured move. Therefore, this is a sell vacuum test of support that also improves the probability for the bulls. Bears will take profits at a measured move down. We have a tail here and a pullback here that does not overlap these bodies. There's overlap of the high of the bar with the low of that bar, but not an overlap of the bodies of this body and these bodies. It's a negative gap. While not as strong as a totally open gap, it's still often good enough for a measured move down. And a measured move down from here to here takes us down to about the bottom of this bear trend. And that is another reason for traders to take profits down here. Finally, we're at the bottom of a channel. You can call it a parabolic wedge, a fairly tight channel with 3 pushes down. Another reason for a reversal. 60% chance at the close of this bar, we're going above the top of this bar. Again, 60% chance that the market is going to get up here before it falls that same distance down. And therefore, an exhaustion gap is more likely than a measuring gap. Initially, the gap is this close to that low. Once we reverse up, it's from this high to that low. And now at this point, we're trying to reverse back down and form a lower high. At this point, the gap is from that high to that low. I refer to the two bars as an exhaustion gap. You can call it a sell climax, an exhaustive sell climax, but I think of it as a gap because at the close of this bar, there is a gap between the close of this bar and this bottom attempt here. Bulls, they can buy the close of that sell climax bar and use a stop just below a measured move. Other bulls prefer to buy a reversal up, especially above a bull bar here or a second entry above another bull bar here, get filled right here. Since it's a high probability trade for the bulls, they can exit with a reward equal to 1 times their risk. Their actual risk is small. Had a bull bought this close, his actual risk would be 1 tick below this bar. If he exits up here, that's several times his actual risk. Trader's equation is based upon actual risk. And since the reward is several times greater than actual risk, even if he only had a 40% probability of success, it's still a good trade. Here we have a 60% probability of success, so it's a great trade. 60% based upon the initial risk. Again, stop for the bulls is just below a measured move down, just below this line. And the target is at that high. So if a bull bought that close or above this bull bar or above that bull bar, they're going to exit at least partial profits here, as long as their profit is at least as big as the smallest scalp. And when you're trading currencies, you should not be trading unless you're going for at least a 10 pip move. A trader buying above this bar, he's expecting to go above here, but he'll only exit if he has at least a 10 pip move. So he'll place his limit order 10 pips above his entry price. Microchannel, that is a very strong channel, and it can be a climax, not based upon price, not based upon the market moving fast, but based upon time, by the trend lasting a lot of bars. 5-minute chart, euro versus the dollar. Whenever you see any kind of strength late in a trend, it can be big bars or it can be 5 or more small bars in a tight channel. you have to be thinking that it's more likely a climactic end of the trend instead of an acceleration into an even stronger trend. Remember, if you have 4, 5, 6 small bars, it's probably a breakout, a big trend bar on a higher time frame chart. Here we have an 18-bar bear microchannel. Microchannel means that the high of every bar is at or below the high of the prior bar. And the market did this for 18 bars. Very strong trend. And on a higher time frame chart, this series of bars on the 5-minute chart would be simply a breakout. On a 15-minute chart, this would be 2 or 3 big bear trend bars. Everyone is eager to sell, but at some point, no one is left to sell. The stop is far away. Bears have to reduce their risk by taking profits, and that leads to an end of the microchannel. The market has to go higher at some point to find sellers. Any kind of a climax is unsustainable. A climax can be a series of big bars, or it can be a series of very small bars. This bear channel has a lot of doji bars, yet it's climactic in terms of time. It lasted over an hour, which is a long time for a microchannel. And as I said, even though the bars are small, a tight channel like this, a microchannel, is a breakout on a higher time frame chart, and therefore it's a climax. A climax is an unsustainable move in the market, and there's a 70% chance of getting at least a 10-bar two-legged pullback or some kind of reversal up, and only about a 30% chance that a climax is going to lead to a strong bear breakout and a new swing low. I talked about the big breakouts that you sometimes see late in a trend. 60% chance you'll get a reversal, 40% chance you'll get a measuring gap. Whenever you have a microchannel lasting a lot of bars, there's a 70% chance you're going to get some kind of a transition into a trading range and an end of the selling before the market falls for a measured move down. Strong bear microchannel. Well, guess what? The first reversal up is probably minor. It's probably going to fail, and traders will sell it. They know the math is high, that the market's going to go at least a little bit lower. They can sell above the high of the prior bar, or they can sell below the low of the prior bar, the breakout of the bear flag. Here, for example, 2 legs up, 1, pullback, 2, low 2 short. If you take any of these shorts, your stop is above the top of the most recent lower high. This is the most recent major lower high, and there's your stop. Some traders don't want to risk that much. They might put a stop maybe above the top of this breakout, maybe a little bit above a 50% pullback, but this is a reasonable stop at the top of the sell climax. Bears selling down here, they know we're going down for at least a small second leg, and after a climax, they're not expecting a lot of selling, so they're probably converting into scalping mode. 3 pushes down, 1, 2, 3, trying to reverse up, 1, 2, and then 3. Reasonable to exit here. Remember, if you're scalping, your minimum scalp size is at least 10 pips. So don't enter a trade planning to exit with less than 10 pips. If your trade reverses to the point that you think you're not going to reach your profit target, then just exit, even though it did not quite reach your target. A lot of the bear swing traders will exit here or here, betting that the market is climactic after that many bars on a microchannel, and it's likely to convert into a trading range, possibly into a very strong minor reversal, and after a very strong minor reversal, traders will look for a major reversal. Another way to draw a wedge, 1, 2, and then 3. So 2 had a few pushes down to it. On a higher time frame chart, this would just be a single bar down. It's a really tight bear channel, and therefore the reversal up is probably going to be minor. Here, there was an exceptionally big reversal up, but it's still minor. Once you have a minor reversal that's very strong, traders expect that when the bear trend resumes, there's a 40% chance we'll then get a major reversal. which is what we got here. Context is good for a swing up. We have a sell climax, micro channel, and now we're starting to transition into a trading range. We're getting stairs. The breakout below this low over here pulled back above that low. We broke below this low and it pulled back above that low. So we're starting to get stairs. And that means that the market is probably transitioning into a trading range, and a trading range will probably have a fairly strong minor reversal up at some point. This is an exceptionally big minor reversal, but it's still a minor reversal. Wedge bottom, when the channel is very tight like this, the reversal up is usually minor. So even though this went up 50 pips, 60 pips or so, it's still a minor reversal. Traders are starting to look to buy. They can see limit order bulls buying below bars, making money. Now we're starting to get more reversals, and we have a decent bull bar closing in its high, a micro double bottom, maybe a wedge bottom. They'll start to buy. With the stop, for example, of that bull bar, minimum target, the top of the wedge up here, which is at least 10 pips up, reasonable scalp. If you take the buy, stop below the double bottom. What happens if it hits your stop? Well, it's probably going to reverse up, right? Bulls have been buying at prior lows for the past 20 bars or so. If it falls below this low, they'll probably buy as well. Some bulls, instead of putting a stop here, will use a measured move down, maybe based upon the height of the wedge, put a stop just below that, and buy more at this low instead of getting stopped out. Had a bull held long, he probably would exit here. We have a parabolic wedge, first leg up, second leg up, third leg up, around a 50% pullback. So consecutive buy climaxes around a 50% pullback, and probably a minor reversal. And traders will look to sell on the resumption of the bear trend. If you want, you can call it a low 4, low 1 or low 1, and then low 2. Instead of reversing down, we got a bull breakout and then 2 more legs up and 2 more reversals down. So it's a complex top. We got a top attempt here or here, and then another top attempt here, consecutive tops. This is a buy climax and a wedge, 1, 2, 3. Chances are we're going to get 2 legs down. While a trader could buy this for a higher low major trend reversal, when you have a very tight channel like this, it's probably the first of 2 legs down. If a trader bought here, his stop is here or here, higher probability to take the second buy, because at this point we clearly have 2 legs down. And again, stop all the way down here, looking for a higher low major trend reversal and a wedge bull flag. The first leg of the pullback is here before the bull trend ended. And that's common. Whenever a market transitions from a bull trend into a bear trend, usually the bear trend begins before the bull trend ends. And therefore, you can get a wedge bull flag where the first leg down forms before the bull trend ends. This is a 5-minute chart of the euro versus the dollar. Small pullback bull trend, gaps all the way up, a gap between this low and this high, gap between that low, this high, this low, and these highs. Maybe a little bit of overlap, but it's gaps all the way up. And therefore, this is a small pullback bull trend. On a higher time frame chart, this entire rally is a breakout. It's a series of bull trend bars. You have small bars. It looks like a bull leg in a trading range, yet it just keeps going up. And the key is to notice the gaps. If you're seeing the gaps, it's probably a small pullback bull trend, and you should buy for any reason, expecting the market to go a lot higher. There's no extreme buying. There's a relatively big bar compared to these bars, but it's not all that big. The same here. So we're not getting exceptionally big bars. So there's nothing climactic, and therefore traders should only look to buy. The pullbacks are small. You can say, well, Al, it went sideways for 7 or 8 bars. Can't I sell? No, the pullbacks are too small for you to make a profit. And if you cannot sell and make a profit, the only thing you can do is buy. The odds are high that we're going higher. Many breakouts, as I said, but they're not all that dramatic. The bars are not all that big, and therefore the market is not getting exhausted, and it's probably going to go higher. Also, after every breakout, the market pauses for 3 bars, 5 bars, and it's working off the exhaustion. Once the bulls see the bears are unable to reverse the market, the bulls buy again. Here's a daily chart of the dollar versus the yen. Anytime I see any unusual behavior, I assume it's unsustainable, because if the market could keep generating unusual behavior, it would not be unusual, it would be common. Look at this. Here's the 20-bar exponential moving average, and the market has not touched it for 70 days. 70 days, the market has stayed above the exponential moving average. That is extremely unusual. In fact, it has not happened in 25 years. If something has not happened in 25 years, what are the chances of it continuing up indefinitely? Theoretically, it never has to come down to the average price. But the reality is the market usually comes back to the average price every 10 or 20 or 30 bars. This is extreme and therefore climactic. Very tight bull channel, and therefore a breakout on a higher time frame chart. No major sell signal. Any reversal down is probably going to be minor. However, once you start to get a lot of bars like this without a pullback, buying a bull flag like this, a double bottom bull flag, you're probably not going to go up very far after 70 bars without touching the moving average. Rather than buying up there, it's probably better to wait for the pullback to the moving average and then buy. What about this? Can you sell below this bar betting on a double top in a tight trading range? There's room to the moving average for a scalp. Remember, this is a daily chart, so this is 500 pips from here to here. Therefore, there's plenty of room for a scalp down to the moving average. Would I take the sell? I don't know. Sometimes when you have a tight trading range, especially after a buy climax, you get a couple legs down, 1 pullback, 2, and therefore it's an okay sell, not a great sell. And for the bulls to have a double bottom here and a bull bar, but we've been above the moving average for so long, I personally would not buy up there. I would only buy after I see a pullback to the moving average. If you do take that sell, do you put your stop just above its high with a double top? Whenever you have a very small sell signal bar like that, putting a stop above its high is a low probability way to trade. Think about it. If you sell below that bar and you put a stop above that bar, your risk is very small. That means you have fantastic risk-reward ratio. Whenever you have a fantastic risk-reward ratio, you know your probability is low. You cannot have a great risk-reward ratio and a high probability of success. And therefore, if you're selling below the low of that bar and putting a stop just above, you're creating a tremendous risk-reward ratio. That means you're probably going to get stopped out. Therefore, if you sell below a very small bar, you should never put your stop just above its high. You have to use a wider stop. You have to take wider risk to increase the probability of making money. Target is moving average. The bulls have been eager to buy. They've been buying above the average price for 70 bars. What's going to happen when it gets down to the average price? They're going to be eager to buy. They finally have a chance to buy at the average price instead of having to buy above the average price. And therefore, if you take that short, you should get out. This is a 20 gap bar buy signal. The market has been above the moving average for more than 20 bars. Usually the bulls will buy at the average price. In fact, the market has been above the average price for 70 bars, far greater than 20 bars. I began by talking about major climactic reversals. 60% chance you get a reversal to test the opposite extreme of the climax bar. And then I talked about how a microchannel can be a climax as well. A microchannel is a small pullback trend, and therefore it can be a breakout on a higher time frame chart. On the time frame that you're looking at, though, it's a climax in terms of time. Remember, every chart is a combination of price and time. A climax can be based upon price, in other words, a very big bar, or it also can be based upon time, the market doing something for a very, very long time that is unsustainable and therefore climactic. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading climactic reversals.